Welcome everybody to today's webinar event. My name is Sean Kozak. I am the founder of NeuroStreet's Trading Academy. And we've got a really special event topic today. We've been planning this for some time. A lot of traders have been requesting us doing an event on this. And I used to do a lot of webinars on supply and demand in the past. And so I felt it was time where we integrated some new concepts and some strategies so that we can help you guys look for some trade opportunities and help you understand what levels trading is using supply and demand imbalances, how to curve map your areas, identifying when you should be trading, demand or supply properly. And we've got just a really great event. I just think that it's a topic that everybody needs to learn, and it's something that a lot of traders are using. So I think it's very, very valuable. First and foremost, before we go into the event, I just want to talk about a couple housekeeping rules with regards to the webinar. I am recording it. We will distribute an event recording after the presentation is done. If you have any questions, please put them in the chat box so that I can reply to them as soon as I see them. If I don't get to them right away, please note I'm not ignoring you. I am simply just staying on topic so that I can do the presentation. And when I do get a chance to go to them, I will. If you can't stay for the entire event, we get it. Lots of people have busy lives. First and foremost, I just want to thank you for your attendance, because the fact that you're here goes a long way, and we just want to make sure that you know that we appreciate your time being with us. So how many of you guys are supply and demand enthusiasts, right? Like, you guys look at supply and demand analysis. Just type a yes if you're somebody that incorporates supply and demand into your trading to some regard, to some degree, and you enjoy looking at it, you understand it, and you're ready to kind of learn some new concepts around it. We got some great things to talk about today. Okay, let's cover a quick disclaimer so that we can get the risks of the business out of the way. We need to go over this. It's required by law. You need to make sure that you understand the risks, right? We're not here to advise you. We're here to help you. Okay, so a couple highlights. Going to talk about the 5 and 5. I want to talk about what curve mapping is. Curve mapping is something that I don't think a lot of traders understand the importance of it. And it's absolutely critical for imbalance levels. It's absolutely necessary, especially for reversal traders. For directional traders, trend traders, depends on where you take the trades. But if you're trading levels, or you're trying to look at, understanding when the market's going to stop and reverse and go in different environments, you need to understand what curve mapping is. Now, the way we've identified the curve mapping is we have two ways to do it. And we use a product called the auction curve, and it allows us to be able to look at the max daily average range for an area, or it allows us to look at structure reversals. Okay. Now, this is going to help us identify where we want to do business as a buyer or a seller. Then we're going to transition into supply and demand analysis. We're going to talk about the SD volume zone system. We're going to talk about volume thrust imbalances, using volume inside of supply and demand areas to identify high probability locations for trade entry, using zone volume mechanics. I want to go into a strategy breakdown. I want to talk a little bit about what I think is really ideal from a strategy perspective. And then we're going to go into the charts. We're going to look at, some examples. We're going to look for some trades, and we're offering a pretty substantial promotion right now as a result of the request on this event. Okay, as a result of a request on this event, because we've had a lot of emails and a lot of people in the trade room asking, hey, when can we do some events on supply and demand? When can we talk about supply and demand? Well, today is the day. Okay, so let's jump into this, guys. You're going to want to stay to the end of the presentation because the promotion is pretty substantial. Okay, so no fluff, no snake oil. As you know, I'm not here to blow smoke. I am here to help you. Okay, trading is not for the faint of heart. It is definitely one of the most difficult industries in the business, in the world, to succeed at. And if we don't treat it as such, we are going to get run over by the guys that understand this. Okay. I've worked with thousands of traders. I've traded successfully. I've had periods of loss. I've had periods of great times, bad times, in between times. I've traded sim accounts, live accounts, and managed accounts. And the reason I say this up front, guys, is because I'm here to help you. I own the school. I'm the owner of the school, and I work with thousands of traders every day. And so the way I can do this is to show you some of the stuff that we do here at the Academy with regards to the indicators that we trade with and the strategies that we've developed through years of teaching students. And then also helping you define, the way you're most comfortable trading, right? Like not everybody's meant to trade one style. So we always like to expose you to different concepts and teach you different methods so that you can understand what's going to be best for you. Now, in order for you to believe in that, you need to see it working, which is why these events are important, because I want to show you strategies. I want to show you examples. We want to teach you how to become better at this. Okay. Now, as always, we have an open door policy. If you ever want to get in touch with me or my team, we are simply an email or a phone call away. We'd be more than happy to share some time with you. So 5 problems and 5 solutions. When we talk about levels in the market, the biggest ones that I think are predominant problems with traders, okay, is knowing when to buy or sell. Like, a lot of traders don't know that. And it's a very simple thing to say, but it's not a simple thing to do sometimes. And then what ends up happening is traders will take bad trades. They won't pass on them. They're always second guessing, and they start complicating the way that they're approaching the market. These are predominant problems that I think a lot of traders go through. Heck, I've gone through them. How many of you guys can admit that you've gone through some of those problems? Not knowing when to buy or sell properly, not passing on good trades, right? Second guessing all the time, complicating things. How many of you guys can admit that this is kind of up your alley to some degree, at least one point in your career? I'd like to think that everybody should be putting a yes in the chat box right now, because if you're not, I want to know what you're doing and why are you here, right? So there's a few solutions. I'm going to show you solutions to these problems today. I'm going to show you where to buy and sell accurately using software, not your own thought process, using algorithms. I'm going to show you how we've developed tools that will identify where you can buy and sell properly so that you're not having to guess anymore. I'm going to help you understand how to go into those areas and fine tune your entry using high volume information with institutional turning points. And the reason I say institution, I don't like to use that as a marketing word. I use it is because institutions trade with high volume. So when there's high volume at imbalances, this is where big money steps in. Okay. I'm going to talk about a simple strategy. Okay. We're going to keep it super simple today. Everybody in here can use this and they can incorporate it with everything that you're doing today. It's going to be so simple that you're going to be like, well, why did I just look at this before? Okay. Well, you can look at it and you can do everything else that we're doing and you can still incorporate it. And the reason I'm teaching this is because I've seen it work for myself, and I've also seen it work for many other people. And for those of you that don't know, I started as a supply and demand trader. It's the backbone to how I got into this business. The very first supply and demand product I ever developed was what kickstarted the school over 6 to 7 years ago. And I've been looking at supply and demand every single day since. So I can teach you guys a lot about it. I know a lot about it. And I've developed code that reads the market based off algorithms around it. So I hope to be able to share that wisdom with you guys. Okay. So you guys ready? Give me a yes. You're Johnny on it. You're ready to rock and roll. We're going to jump into some curve mapping. We're going to talk about how to identify what we need to be doing here. Let's do this. Okay. Curve mapping. Let's talk about it. Curve mapping is understanding historical auction price ranges. So when you understand historical auction ranges, this will help you define what to expect in the current day. Let me repeat this. The only thing that we all have to our advantage is understanding what happened in the past, which is what makes this business so bloody hard, because we're looking forward, but we have nothing to go on. So we need to use historical information to help give us a roadmap. Now, can that roadmap be perfect? Yes. Can it be imperfect? Yes. So it's a map. It's kind of like a map. Can you stray off course? Yes. Can you get lost sometimes? Yes. I'm sure everybody's been on a road trip once in a while. You took the wrong turn, right? Well, curve mapping is about identifying your areas, and then we need to know where to participate within them. Now, there's a few ways you can do this manually, quite difficulty, like with difficulty, because you have to be paying attention to higher time frames, and you need to be, using, you have to be identifying the ranges, and you can do that. But what we've done is we've developed an indicator called the auction curve, and it will automate the roadmaps for you. Now, the auction curve uses two algorithms internally. It uses the structure reversals to basically create the ranges based off prior major turning points in the market. And the other side of it will look at the max ATR ranges. So taking data from the daily timeframes and bringing it into the intraday timeframes, okay? Now, why would this be important? Because as a supply and demand trader, okay, you need to understand where value is, and you need to understand where retail is, because value is when things are cheap and retail is when things are expensive. Now let's kind of put this into context. If you own a restaurant, you need to buy your inventory. If you do not buy your inventory at a discount, you cannot sell it for a premium and make a profit in your business. Trading is the same thing. The only difference is that we're trading a financial asset. We're not buying and selling inventory in a warehouse, but we treat it the same way. Okay? We need to buy things when they're cheap and sell things when they're expensive, and vice versa. But to me, that's a bunch of baloney. And I'm going to explain it, because everybody in this room, everybody in this event can recite that. You could go on Google and type in trading, and it's going to say buy low, sell high, and then you're just supposed to expect everyone to know what that means. Not that easy, okay? Because the problem is that a lot of traders don't understand where low and high is. And a lot of times when we think we know, the market kind of throws us a curveball once in a while. And so the main question here needs to be, and it always needs to be, before you enter any single trade period, is am I buying the market or am I selling it? There's only two positions you can ever take in the market unless you're hedging on both sides, and that's you're either a buyer or you're a seller, okay? Now, the auction curve tells us where we want to be buying and where we want to be selling. Okay, so let's take a look at this. This is a chart. Okay, 1, 2, 3, 4. If we're here today, we don't know what's going to happen, right? All we know is that we're opening right here. That's the open of the Globex. But we got 1, 2, 3, 4 days behind us, okay? So what we need to be aware of is that every single day, has a price range. This was the high. Say that was the low. This was the low. This was the high. So let me ask you this. What do all 4 days have in common? Trick question. It's important though. What do all 4 days have in common? Highs and lows, okay. All 4 days have a high of day and a low of day. all days, every day has the highest traded price and the lowest traded price. This means it was the price in which the market stopped at the highs that day, and it's the price in which the market stopped at the lows that day. What do you think that is? That is the institutions setting their range for the day. We don't know what they're going to do. We don't know how the market's going to respond to their decisions. We just know that big money's doing business, and some days they keep it tight and some days they keep it wide. Okay? And I'll go into your questions after, guys. I want to stay on topic before I go into answering questions, okay? So what does every day have different? What is different with every day? Jerry says price. Every day's range is different. Okay. So if I'm here, if I'm coming in here at the open of day 2, I know the range for day 1. If I'm coming into the range of day 3, I know the range for day 2 and day 1. If I'm coming into the range of day 4, I know I can see where price traded all 3 of these days. The difference is I don't know what's going to happen today. I just know what happened yesterday. So the only thing we can do is we can formulate an environment that tells us what the bigger guys view as cheap and what they view it as expensive. You want to know why? Because they sold up here and the market's going to buy back down here to some degree. If they don't, then guess what will happen? They'll shift down again, and this will then become expensive where they sold again because the market's trending. 80% of the time, the market wants to stay within at least a normalized range of each other because it's easier to do business. There's going to be 20% of the time the market's going to go into discovery mode and try to shift new environments. We never know that. We've seen that yesterday massively on the S&P and the NASDAQ, but we never really know. We've seen that today a little bit, but they didn't really trend it. They flushed it up and they flushed it down. They kept it in the auction. They just really manipulated price due to fundamental news. So what does the auction curve do? The auction curve takes all of this information and automatically moves either up or down based off of the data to show us a range in which we can identify our inventory. Our inventory means when should I be looking to sell and when should I be looking to buy. Nowhere in here does it tell me the exact place I should be getting into the market. All this is your compass. This is your map. This is like, okay, I've got a map now. This is like the bird's eye view. Now I got to go down into the cockpit and I need to start figuring out how to fly this baby, right? So there's 2 ways in which we map out this grid. We don't just take the high and low of day, okay? We don't just take the high and low of day. What we do is we take 2 separate indicators. One of them is the ATR forecaster, which looks at your daily price ranges. Daily range. Now, on a daily chart, you're looking at a big time frame. You have a minimum range, you have an average range, and you have a max range, which means bare minimum, most days trade that certain amount of range. On average, you'll see some movement, and then normally the maximum. I want to know the maximum because I want to know the maximum of expected movement this market's likely to trade from one end to the other. If it stays within that, that's fine, but at least I know that's where the market's likely to go that day to some degree. So if I was coming in here, day 1 to day 2, this yellow dotted line here and here, this is the max ATR line. If I'm coming into here to day 3, this is the max ATR line, which means the daily average range is that wide. Here, max daily ATR, okay? So what we do is we first use that. Then what we do is we take a look at the prior open, high, low close. The prior open, high, low close looks at yesterday's high and low of auction. So if I'm coming in from day 1 to day 2, this blue line here is yesterday's high. This blue line here is yesterday's low. Yesterday, which is here. Yesterday, which is here. So if you take a look at where my arrows are drawn up here, okay, this is the low price of yesterday, and this is the high price of yesterday. We're forecasting yesterday's low and high of day, and we're also forecasting the max ATR. And what the auction curve does is it looks at both of them. It doesn't just look at one, it doesn't look at the other. It uses both of them because sometimes yesterday's high will be above the max ATR. Sometimes like this, like you see the max ATR is here, yesterday's high is here, okay? Sometimes you'll have yesterday's low outside of the max ATR. You don't know that. You'll look at this. This is yesterday's low, but the max ATR is here, which means that even though this market's expected range is here, if they break out of that, there's a good chance they're going to test yesterday's low of auction. This is how the market works because it's going to go to test yesterday's lowest price ranges. And this is how the market works because it's all they have to go by. All they have to go by is yesterday's forecasted auction levels and the volume which the market can facilitate liquidity within those ranges. The only thing that makes the market go outstanding and basically unpredictable is fundamentals, which nobody can control, like GDP. Nobody can control how the big policymakers are going to create new policies or how the market's going to be with the economy. The market just responds fundamentally. And then after all those fundamentals are done, the market goes back into technical trading environments. So today was a great example of a fundamental news day. But now once all that news is out, we don't got to worry about GDP for another month. It goes back to technical environments, right? Does everybody understand that? Give me a yes. So what we're doing is we're wrapping the auction curve lines based on the maximum of the two. So we take the highest of the two and the lowest of the two, and we wrap a grid around this. Retail, value. Depending on what's the highest price and what's the lowest price of those two. You notice how we're taking both of them, but we're not using this. We're not using this. We're using the highest one of the two and the lowest one of the two when it's set to this setting. The other setting is looking at the structure reversals that create the high and low of day structure changes. So what we're doing is we're looking at the low or the high that created the reversal in the market. And so there's two ways to go about this. In strong trending markets, you're not going to have access to the reversals. You're going to have access to the ranges. In range bound markets or tighter markets, you'll have access to the reversals. So there's two settings, and you have those settings to be able to look at where the map is. So we're able to identify structure pivots that create major reversals in the market, or we're able to look at daily ranges that create based off of the maximum price movement for those expected markets. And it's always different for every instrument because the range of every market's different. And the auction from prior days is different, okay? So why is this important? There's a reason behind this curve mapping stuff. I'm not just talking about it for no reason. Well, because when we start looking at trading entry places, like when we start looking at trying to get into the market and we want to know where to get in and where to get out, this now starts to focus more on not the map, but the flying of the plane, right? So if I'm sitting here and I know that I've got a price chart, okay, and I know that I've got my range like this, and I know that I'm in expensive territory and I'm in cheap territory. The question is, where in expensive territory should I be selling? And where in cheap territories should I be buying? And the next question is, am I trading reversals or am I trading trends? because there's two ways to trade up here in this reversal environment. You could trade as the market's coming up into this as a reversal trader, or you could be trading as the market's coming down to this as a trend trader and still be shorting on both sides of those markets. Same thing here. You could be buying as the market's coming down or waiting for the market to transition and you can start buying as the market's trending up. You're still in cheap territory. And the only difference between the two of this is knowing if you're an aggressive trader or a conservative trader. Okay. So the concept here is professionals always sell in retail. That's a given. But the question is, are you fading? Meaning, are you trading reversals in expensive territory, or are you trend trading it? Okay. The next one here is value. Are we fading it, or are we trend trading it? The problem is, most new traders do the opposite because they react to the market. They react to it, which is not a bad thing because everybody needs to learn through mistakes. But we need to correct those mistakes. And we need to make sure that you have a plan in place to know how to do something different. So I want to ask you a very personal question. Do you consider you're a professional or a novice still? Type that in the chat box. There's no right or wrong answer. I just want to know what you think of yourself. Excuse me. Where do you see yourself? A novice, a professional? Being honest. Good. Guys, if even professionals are learning. Let me ask you a personal question. How many of you guys have been to my trading room, or have you been to one of my webinars in the past couple of years? Give me a yes if you've been to my trading room or you've been to some of my events. Okay. Now let me ask you another question. Okay. Now this is a bold question. Okay. This is a real bold question. I'm just going to put myself out there. How many of you guys think I'm experienced? Okay. Well, let me tell you this. I'm always learning, guys. I make mistakes like you ain't believe. I'm always learning. But you know the best part about it is that every time you step forward, as long as you're correcting the things that you were doing before, you can start calling yourself a professional. So you just need to think that even though you may start somewhere, you just need to understand how you approach things. Okay? So what I want to do is I want to talk about supply and demand. You can draw your levels manually, or you cannot. Okay? You can rely on manual thought process, or you can rely on a computer algorithm to help you. I prefer computer algorithms called indicators, and I'm not talking basic tools here. I'm talking volume-driven tool sets. Tool sets that are designed with specific mathematical volume indicators that are used to identify quantitative information in the market. So let me explain that. If I'm going to be a buyer or a seller, our software will plot the zones, okay, for supply and demand on your chart, so that you don't have to worry about where supply and demand is, okay? Our software uses an algorithm that is based on 3 components. The first one is based off volume thrust imbalances. Now, I'm just going to be the first to tell you this so that you understand. We always get a lot of questions. How is your supply and demand software different than all of the other supply and demand softwares? and I'm going to explain, okay? Every supply and demand software that I've ever seen, and I've seen every one of them, trust me, and they're all good. They all have their pros, they all have their cons, right? Is using structure analysis to formulate the levels. And then they add volume inside of it. We don't. So all we're doing is we're looking at volume profile areas and pattern recognition. So the difference is that our zones are based off volume weighted TPO. So what, if you've ever seen me talk about the auctions, there's volume profile and there's TPO, okay? Our software, our zones are built from TPO imbalances. So we're not just here, draw your lines around the candle. We're not here, take the high of the wick and the body. No. We're looking at price and the value areas that are creating these TPO profile imbalances. And then what we're doing is we're looking at thrust bar breakouts. So when price breaks outside of these volume profile imbalances, it creates supplier demand based off breakouts in the TPO. Okay. So when someone says, hey, Sean, how is your supply and demand software different? Well, it's technically supply and demand profile zones, if you really want to get into it, right? If you really want to get down to the nitty gritty, it's volume weighted TPO zones, which is another word for saying micro auctions. And the reason you'll be able to see that confluence is when we start looking at the higher time frame 30-minute profiles, and we start seeing an overlap in the smaller time frame zones. A lot of you guys are starting to see that now, and now you're understanding why. So there's 3 steps to a zone creation, okay? Step number 1 is we will have these black candles here, okay, these black bars. They're significant. Those black candles are the beginning forms of a balanced area. So it's the tug of war. So as you know, if you've ever been into my trading room, or you've ever watched a profile webinar, maybe you have or maybe you haven't, there's 3 profile patterns. There's a P, there's a B, and there's a D. What do all 3 of them have in common? Let me just see if any of you guys have ever studied profiles or if you've ever known this or anything of the nature. Yes, okay, so they all have a value area. Okay, perfect. Anything else? They all have a point of control. They all have, yeah, okay. So let me explain this. They're all to do with identifying a balanced area. So there's always a balance area that happens in each pattern. What the black candles are doing is they're identifying the balance area. They're identifying a balance area. They're identifying a balance area. Okay? Whenever we have a balance area, okay, whenever we have a balance area, the market's got to go in one direction, right? So if the market's coming here and it's going like this, eventually the market can only go up or down. What do you think will cause that? What do you think the market will do if it goes up? How can a market go up? Demand steps into the market with volume. How can a market go down? Supply steps into the market with volume. So what we do is we move to step 2. And what we do is we actually look at a thrust bar breakout. These fluorescent candles are identifying a breakout of the ranges. They're breaking outside of the volume weighted TPO value areas. The value area high and the value area low. So what happens is whenever these candles break out significantly with a value area high and it breaks outside of that range, guess what? That is demand driven by volume profile. Pretty important information, I think. And then at the close of these candles, we confirm the zone creation. So zone creation of supply and demand can only happen if we can actually prove a breakout from value. Interesting. Interesting. So these are volume thrust imbalances created from TPO breakouts. Did anybody learn something from that? Give me a yes if you learned something from that. If you're not here learning, no good, right? Okay. Now what I want to do is I want to talk about why this is important, because this is going to tell us where supply and demand truly is in the market. And then what we're going to do is we're going to take it one step further. We're going to go in and we're going to use the profile inside of those imbalances. Now, every zone has a profile, a volume profile, a point of control, a value area high and low volume nodes, high volume nodes, and volume clusters. My job is to help you find the levels, okay? Find the levels. So let's draw a price chart like this. My job is to get a price chart, grab our curve map, retail and value, help you find a supply zone, help you find a demand zone, and then look at the volume inside of these areas to show you how to reduce your risk, okay, for better trades. You get it, okay? My job is to help you understand if I'm going to sell, where should I be placing my entry in here so that I can get the best opportunity? And should I be trading every single supply zone and every single demand zone, right? If I'm going to be buying, where in demand should I be planning my location? So the way I like to do this is I like to take you through a journey of keeping it simple. Step number one, and take a screenshot of this. This is super important. You'll have a chance to go over the video when we work on this. And I'm going to go over some of your questions in a second. Step number one is the auction curve. We're going to look at the map, and I'm going to look at locating retail and value. Step number two is we're going to go into the SD volume zones, and we're going to look at where am I planning on taking trades. Step number three is identifying the volume data so that when you get ready to buy or get ready to sell, you know where to buy and sell inside of those zones. And then step number four is making sure that as you take trades, you journal them and you repeat and you move forward with your process, okay? So what I'm going to do is I want to go in and I want to look at some markets. Now, a couple of questions came in while I have a chance to kind of go back up here and answer these, okay? Let's go back up in here and just make sure I don't miss anything as we're going, and then we're going to go into the charts, and the rest of the presentation will be on the charts, okay? 1 second here, guys. Just want to make sure because I had a lot of people. Okay, so first one says, are these the same as OTA zones? Absolutely not. Those are structure levels. So those are based off price action alone. And, you know, that's where most people start. And it's not that they're wrong. These are volume driven imbalance level. These are market profile zones. Yeah, these are based off TPO analysis. Yeah. And the time frame is irrelevant because I'm going to show you we can trade on any time frame, any market. It doesn't matter what you're trading. But what it does matter is that you identify your temperament, right? The smaller the zone, the more noisy the market. The smaller the time frame, the more noisy the market. Okay. So what I'm going to do is I'm going to go and we're going to take a look at some markets. Now I've got a workspace here, and I'm talking every market. I've got major futures contracts on the left chart over here. I've got all the majors for Forex, and I've got all the big the ETFs. Okay. Ingrid, I'm not sure you understand. You don't need to go inside it. It's already volume-driven zones. All of our zones are already populating the TPO imbalance. So all of the zones are already doing all that. You can't use a standard volume indicator because we have an algorithm that looks inside of the levels. If you look at the candles, they're all colored. Yeah, we're going to go on it, guys. Give me a second here. So if you take a look, every candle's got a different color. It's because we're looking at the imbalances in the TPOs. We're looking at the breakdown inside of the volume inside of these candles to look at basing imbalances and then breakouts. Okay, so it's completely different. It's not even, you can't even compare. It'd be like trying to compare a boat with a bike. Right? Totally two different methods of transportation. So what I want to do here is I want to take a poll in the room here because we've got a couple asset classes. Futures, Forex, or stocks. What do you want me to look at first? Ingrid says futures. Tom says Forex. Futures, Forex, stocks, guys. Type the word in here. Futures, Forex, stocks. I got a bunch of futures traders, got some stock traders, mostly futures, futures. Got some futures, got some stock traders, got some futures traders. Okay, so we'll take a look at futures first, and then we'll look at Forex and stocks second. Okay, so what I'm going to do here is we're going to just maximize this chart. Let's go here and turn. So just so you understand, there's indicators. Okay, so this is very important. There's indicators. Then there's Ferraris. Okay. I've dedicated 10 years of my life to building trading Ferraris, not indicators. So the difference between Neural Street Trading Academy is that we do not design basic tools. We design software applications that solve major problems in market inefficiencies. So the reason for that is I'm an engineer and I'm an architect. I don't code, but I build massive architectural structure for our development team. So you say, Sean, what does that mean? It means that if you take a look at this drop down, this is ultimately all of the different features and functionalities of the zoning technology that we've built. Now, let's go back in here and talk about what we need to do first. What is the first step? Okay, let's take a look at the NASDAQ. What is the first step in the 4-step strategy? Because this is what you came here to do here, guys. You came here to what? Keep it simple, learn a strategy, make some cash. What's the first step in here? We need to identify the curve. Okay, that's called curve mapping. So before we go into the zones, let's turn them off. If you look at the curve map today, the market opened here. And I got a 15-minute chart here. You can look at it on a 30. You can look at it on a 5. You can look at it on volume charts, range charts, whatever you want to do, guys. I'm just keeping it simple for the purpose of demonstration. Majority of all traders are looking at time-based charts predominantly, especially if you're depends on what you're looking at. Okay, depends on the market and preference. If you're using tick charts, volume charts, we could load a volume chart or a time chart, whatever the case may be. Okay, but that's the open right there. So at the time of the open, right there, you see how this gave me a map? So as soon as that market opened in the Globex, I have a roadmap. I have a roadmap that separates my market into expensive or cheap. Now, what you may or may not know, and I didn't talk about this, we're going to talk about this now, is that I got another map up here. And this is kind of like your go-to gauge to say, okay, what's going on here? What's going on in the market? The first thing I want you to do is I want you to pay attention to curve. The curve is called the map. This is the curve. Okay? It's going to take a look at current price, and it's going to tell you if you're in retail or value. Deep retail or value. Some traders will set this so that it looks at two grids. Keep it simple. Retail or value. You're either expensive or you're cheap. But remember what I said earlier about defining you as a trader, because when you're in retail, you're planning on selling, right? You think about a seller. You should be thinking as a seller. Because why are we thinking of selling up here? You're in supply, it's expensive. Gary nailed it. You're expensive. But as a seller, you have two stances in the market. You can be an aggressive seller, or you can be a conservative seller. What's the difference? What do you think the difference between an aggressive seller and a conservative seller is? Luke nailed it. Trend or reversal. As a trader, if I'm looking to sell up here, we're also looking at structure. So we take these two components, location and structure, and we map them together so that I know if I'm going to be an aggressive seller, if this had down structure and I was here, it would say conservative seller. But it's not. I'm aggressive. Why am I aggressive? Because I'm making higher highs in price, which means if I'm selling up here in supply, I'm trying to stop this market. Counter trend. So you're aggressively selling. You're a counter trend trader. We automatically tell you what you're doing. So this auction curve looks at the map. It looks at the direction. It looks at you, and it says, am I going to trade this now or I'm going to wait, right? This is exactly why this is all coming together like this. So a couple things here. As an aggressive seller, if I go put my zones back on, I got to put broken zones on because broken zones will tell me past levels. Okay? Past levels. So I want you to understand something. If we're going to go up here and we got a big level of supply that stepped in here on the NASDAQ, just because you're expensive doesn't mean the market's ready to stop there. You're going against the structure. But what I can tell you is that if they do come back up to this level, we can see the volume at this location. So what our software did right here is it basically told us that inside of this imbalance, the institutions sold this market most here. Which means if you're going to be risque and you're going to take the trade aggressively, because if you short this supply zone, you are very aggressive. And it is in retail, so yes, you should be thinking about selling, but that doesn't necessarily mean you have to be a counter trend trader. You could very well wait for the market to do this, break down, form new supply up here, and then wait for it to come back and sell it on the way down. Instead of trying to stop this market here like this, which is what that would be doing, you could wait for that supply to work, kick down, break structure, kick back. That's the difference between having a stance in preference. Both are correct in terms of how you decide to trade the market. So, supply is here. Once again, if I'm going to sell this supply zone, I am aggressive. I am going against structure. And if you think about it, makes kind of sense, right? This is an impulse leg. This is a corrective leg. So if the buyers kick in, they're going to try to probably push through that supply. Think about where you're at and think about the structure and the direction. Let's take a look at the volume node. This is a 15-minute chart. It came into the volume cluster. So this is something I want to talk about here inside of the zone volume data. Very important that you learn this, that inside of every single zone, you've got a point of control, you've got a volume cluster, which is this black outline, because that's the highest point of volume inside of the zone. There's the point of control, which is the single point of price, and then there's the volume cluster, which is the 3 point of controls together that are the biggest. So the 2 settings that I normally leave on are my profile features. Let's go in here and let's go and I turn off the value high, the value low. I look at those, okay, just like that. And I will, it did. Let's wait for a second. Now, I'm not saying that we should sell this supply zone. What I'm saying is that you need to understand this curve map up here and when we should be participating. Make sense? Because this supply zone gave a reaction out of it, and then it came back down to test this. Remember what I said about the market up here. If you try to sell this, you're going counter direction, okay? It did give a reaction out of that supply zone. Remember, this is a 15-minute chart, but eventually they chewed through that supply. And they kicked down. They came back down into it. Now, I want to talk about this demand zone for a second. Look at what happened after the market broke up here on the NASDAQ. Do you notice here how the structure changed? Look at the map above me on the top left. Conservative sells. Why is it saying conservative now? We're taking out the lows, lower lows in price. You're breaking structure. Now we're going in a downtrend and we're in expensive territory, yes? We're in expensive territory. We have structure shifting down. That means if we short, we're going with the market in expensive territories. Now I'm in demand and supply. This is what we call a sandwich. We don't trade sandwiches. Okay, there's no safety. You have no room for profit. You do not trade supply when you're in demand. It's a losing battle. Okay, it's a losing battle. Okay, it's dangerous because now you're stuck into a wedge where you're inside of supply and you're inside of demand. Do you really want to be in here right now? No. Dangerous. Dangerous, dangerous, dangerous. Look inside this demand zone for a second. Where did they take it? To the point of control. The only thing is that we're expensive up here. We are getting quite expensive. Okay. Look where they came back into this supply zone here. It's not so much about the zone, guys. I don't care about the zones. I care about the volume data. The zones are just a nice fancy way of wrapping around the auction up here. All we're doing is we're taking these black candles, because remember we said that's the TPO imbalances, and we're wrapping zones around the profiles. Because that's all we're doing is we're looking for black candles and we're wrapping profiles around it. Okay, so right here I'd be looking to sell at this location. Why would I want to sell that? I'd want to sell that because I have room to come back down to demand. I'm expensive and I'm in a downtrend in expensive areas. I have distance to profit. Does that make sense to you guys? The trade map tells us where we are, which is very important. You need to know if you should be selling or should be buying. The structure tells you if you're conservative or you're aggressive. The zone and the volume tells us where to plan the engagement. Okay? Back down to demand. Right in here. Okay? Now, let me ask you a question. I don't care if a demand zone came in here. Why would I not want to touch demand in here? Why do you think trading demand in here is aggressive? Well, first of all, we're expensive. Buying demand up here is expensive. You're chasing a market. So what if we come up here into this supply zone? That's the question. What will happen? I want to know if you guys can see it. If we get up into that supply zone, yes, we're thinking like a seller, but I want you to pay attention to the structure. If we come up into that zone, what will change up here? I'll be going up, right, Jerry? Structure will be shifting up, which means I'm either what? Am I trading a reversal or am I trading a trend? Trading a reversal, you're going up and you're trying to sell. Remember, you're a seller in expensive territory. So if you're trying to sell and the market's making higher highs, you are a reversal trader. You are going against the market. Here, you're going with the market. Downtrend, 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 pullback into supply with the market at expensive territory. If we catch this reversal up here, you're in expensive territory going against the market. Does it mean it will work or not? No, it means that you need to know the difference between are you a directional trader or a non-directional trader. Where would the better place of entry be up here? The highest probability for big institutions to start selling this market again, if they're going to stop up here, will be at this volume node. Now, there's always a risk of them blowing through it. Why? Because we're going against the market. I don't know if they got back up there or not. Went sideways in the overnight. That was the news off the GDP report. So there's nothing you would be trading into anything off the GDP report. Okay. As I mentioned, you're going against the market. Now let's talk about what happened on the way down. Okay. Let's go back and turn off supply. Now let's leave this on here for a second. Big supply stepped into the market. They're coming back down. Let's go back here. Boom. Now, let's talk about this demand zone. I want to pay very close attention to this demand zone for a second. Where are we in the map? Where are we in the map down here? We're in value. So we're in value, which means we want to be a buyer. Yes? Okay. So if you're going to be a buyer, you're either going to be an aggressive buyer or a conservative buyer. So if the market's taking out that structure coming down into this zone, guess what you're doing? You just need to know you're being aggressive. Fading a reversal against structure is aggressive. It's not that it's bad. You just need to know the difference between trying to step in front of a market versus waiting for the market to trend down there in your direction. Okay? That's the concept today. Is are you aggressive or are you conservative in these locations so that you decide, are you going to wait for the market to trend in those locations or are you going to be aggressive? And the trade map does that for you. The auction curve does that completely for you. The zones tell you where to buy. The auction curves tells you when to buy. Okay? So let's go back down here to the zone data for a second. Let's just go back over to this demand zone for a second. Let's go over here. Let's talk about this. At this time, there was 2 black candles here. And inside of these black candles, there's a value area high, a value area low, a point of control, a volume cluster, high volume, low volume nodes, and then eventually we had a breakout, which is that bar right there. And as soon as that candle closed, confirming a breakout of the value area highs, we wrap a profile around the TPO breakout environment. That's all we're doing. If you really want to take the zones and remove the zones from the chart and just have a profile there, that's all we're doing, is we're wrapping profiles around the imbalances. Okay, so the concept of this is, what's the most important price in here? That's the question you need to start asking yourself. If I'm going to start trading supply and demand imbalances properly based off market profile, because that's what this is, what is the most important price? Price never traded into it before, Ingrid. So what we're going to do is I'm going to show you here. It was never tested. So we're going to go into tested shading. So if you take a look at when it was tested today. Let's go back to it right there. That's when it was tested right here. It was never touched before. Okay. So price closed here and traded that way for a while. But let's go back to my question. Okay, let's stay on topic. What's the most important price in here? The volume cluster in this environment right here. It's the highest node. So if you really want to get right down to it, nitty gritty, what I like to do is I like to just come in here and just wrap my lines around auctions like that. And that's where I'd be planning my long. In that demand zone, if I was fading this market to the long side in value. The next time I would actually come down into anything else. Okay, the next time I would come down in here, if I was trading down here, look at this is a little bit more difficult because you got a really big node. Look at this, you got a really big node. So guess what that means? If all the volume's equal, you can't just tell the market, hey, I want you to change because I want it to be different. You got to trade the volume. So if we look at what happened, they came straight down to it. Right down to the most important price in demand. Now the problem with this is that not everybody wants to step in front of a market. Okay, not everybody wants to step in front of a market. That's okay. So what you would do is if you weren't going to catch the reversal like this, if you weren't trying to trade long like that, what you would do is you would wait for this market to come through here, trade through it, push up, form demand, and then trade demand here. Because now you're trading an uptrend, you would be conservative and you would be in value, and you have to let the market transition to do that. So as a directional trader, you would not be trading the NASDAQ long today. You see what happened here? We put in some demand. There was supply. Now I want to talk about this supply for a second. Kind of important. It's very important actually. Where are we again? Where did we go back to in terms of the trade map? We're back in retail, Ingrid says. Yes. So what do we do when we're in retail? We sell. Okay. Now, what's the structure of this market? I ask questions like this because I like to teach. Just because we sell stuff doesn't mean I can't teach you guys all the goodies here, eh? Like, this is what's important. I want to get you guys thinking like professionals. That's the whole concept. Structure's down. So if I'm with the market, boom, boom, impulse, correction, imbalance creates at the high of the pullback. Supply steps into the market to stop the correction. I'm a conservative trader up here. Why? Because I'm trading with the direction in retail. So when we know this, if you're a directional trader, this would be your trade again. So what we do is we come in. What's the most important price point in this zone? Now we're getting a bit late in the day, mind you, but what's the most important price point in this zone? The volume cluster and the POC. There's the node. So instead of taking heat like every inexperienced supply and demand trader does, because they're just taught to wrap your lines around a bunch of candles and let's hope for the fences, why don't we look and start thinking like a professional trader and start realizing that the volume data is the most important part in that imbalance. So if I'm going to take a trade in here, that would be my entry. Bingo, bango. That's it. That's the concept. So that's a great question, Ray. So it says, I'm on a 15-minute chart. Is that better than a 1 minute? Okay, so let's start talking about trader type. Great question. Great enough for me to stop for a second. Okay, you got pretty much four categories of traders. Okay. One to 5 minute, you're between a scalp and a day trader. Now this is an argument. I know a lot of traders say 5 minutes, that's not scalping, that's day trading. It's a preference. To a Forex trader, a 5 minute chart is like hyper scalping. The spreads are crazy, right? To a day trader on futures, like, maybe you're going in the 1 and the 2 minute. Let me explain a few things, okay? You're looking anywhere between 5 to 30 minutes or 5 to 15, or I would say 5 to 30 minutes. You're starting to go anywhere between day and intra swing. And it's all preference based on risk tolerance, market selection. Anything above 30 minutes, I consider swing trading. Anything above 30 minutes is a swing trade. Why? Because everybody under 30 minutes is an auction trader on the prop shops. Anything lower than 30 minutes, you're considered day trading. Anything above 30 is you're starting to think about bigger positions, maybe holding into the close and stuff like that, which puts it into swing. So outside of that, okay, you got to ask yourself the difference between noise versus conviction. Okay. If I've got a zone on, say, a 1 to a 5 minute chart, more noisy, right? You're in the crossfire of the institutional movement. Like anything under 5 minutes is you're starting to get, because you remember supply and demand in environments are, it's about imbalances in the profiles and the volume data. Big traders take time to build positions to turn supply and demand around. Like this candle, it took 30 minutes for that zone to create in here. How do I know that? 1 bar for the black imbalance, 1 bar for the breakout, which is 30 minutes. That's not noise, that's conviction. That is kind of like, okay, the market's actually putting in supply in here. But if you go in here, there might be like a bunch of zones in here on a smaller time frame. And you gotta, the more you go down in your zones, the more noisy it gets. So it's not it's not a bad thing or a good thing. It's just you need to understand the risk tolerance around that. Let's bring this down to say a 5 minute and just take a look here. Maybe I'm getting data lockup. There it is. So we didn't actually get supply there on that. Okay, we didn't actually get supply there, but we had it here. We had it as price was coming into that level, but here's the difference. You can see that the structure is different. You can already see it. You can see now, take a look. If I'm a short seller in this zone at the point of control, that was a directional trade in retail. Structure's down, pullback, boom. It came to demand. You would have got a little bit of a movement out of that. But if I'm coming up to this zone, guess what? I'm a reversal trader here. I'm not a trend trader on a 5 minute chart, which means you're going aggressively into the 5 minute. So then what happens is price comes up, it hits the level, blows through it because you're being aggressive because you're trying to stop the market here on the 5 minute. It stops, puts a little demand. We don't trade demand in retail because demand up here means nothing. It's expensive. It's just a small little pattern in the profile. And then what happens is we put in supply here. Now here's the thing. Even here you're aggressive. Even in this trade as a supply trader, you're aggressive. You're going against structure. Structure hasn't proven down yet. So when price came back up to test the high volume node, that is an aggressive short. It still worked real great. Still worked real great. Now here's the difference. This was an aggressive short. This was an aggressive short. Now this was a trend trade. This is a reversal trade that would have kicked you out depending how tight your stop was. This was an aggressive short that worked. The question is, what happened at the close of this bar? We broke the structure. We changed our map. We changed our environment. Our environment changed. So now you're looking on a 5 minute and you're trading on a 5 minute where you never even left the downtrend on the 15, but on the 5 minute, this now confirmed. So when price comes back up, what's the most important price up here? The volume cluster. We didn't quite get there, did we? We didn't quite get there. You can see the tested shading. It came up, popped right there, and it closed. We're in supply on the close. That's a trend trade. That is a trend trade, conservative short. Don't you dare start putting the sells in here on the Globex Open just because the webinar's ending. I will not be held responsible. Yeah, so if you're wondering why price trades through 1 and 2 minute zones, let's just kind of repeat that, because it's not supply. Yes, it's supply by nature of our software, but it's not supply by nature of an institution or a bank or moving money around. Like, they're not looking at small time frames. They're thinking liquidity. They're thinking I need to move big money around. So they're not looking at the small noisy charts. The only reason retail day traders start trading on small time frames is because they think that trading 25 trades a day is an edge. They think that scalping is the reason why you're going to be successful. I've met my entire history of running a trading school, I would say 3 to 5% of all successful traders that I know are actually scalping small time frames. All of the most successful traders are trading around anywhere between, you know, the 1 to 5 minute levels trades, but they're not scalping small time frames. So if you're in a position where you're like, maybe my perspective needs to change a little bit on the levels or the time frames that I'm trading, the question is really around if you're not capitalized to trade some of the markets like the NASDAQ or the S&P, there's micros, but it's more about why do you want to trade a bunch of false noise? versus information that can actually be more powerful, right? And it's not about one is better than the other. It's more about having a preference and thinking. If I look at the 30-minute, there was the 30-minute short coming up to retest the high. Look at this was a swing trade. So this is the 30-minute. We put in this big imbalance off the highs. We broke down today. We came down into the 15-minute zone, which you would have never seen down here on the 30. But then we've got this volume node up here, which is massive. Okay, big node in here, which is why they stopped right in front of it, because they front run the volume a lot on the high time frames. So they came back up, boom, 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 right into that node, and they dropped it. Same concept, just on a much bigger perspective. 30-minute pulled back into a directional trend trade in retail. But if you're looking at it on the 15, we were able to catch it here. Okay. So let's kind of bring this home a little bit and let's take a look at, and the same thing happens. Give me a Forex market, guys. Give me a Forex. I just chose the NASDAQ because everybody knows it, right? Let's take a look at this. Number one is the auction curve tells you when to buy and when to sell. Tells you if you're aggressive or conservative. Very, very important. SDV tells you where to buy and why to buy at high volume, big money data. 3, NSTA shows you the map and the location to trade. Okay, now a good question came in. You don't need to know how to read market profile for supply and demand trading, because you just need to read the auction inside the zones. That's all you need to do. And if you ever need assistance on that, we've got guys here that'll help you. I can help you in our classrooms, and we can do it as well. Okay. But I want to kind of talk a little bit about something real quickly, is that we had a good question come in here about stop loss placement. Now, trade management is a preference, but a very simple concept of our software is we actually have an average stop loss calculator. Now, this is pretty fantastic. What we do is we understand that all the zones on your chart, like there's a lot of zones, yes? They're not all the same size. Okay? They'll never be the same size because supply and demand doesn't work like that. But what we do is we take a mathematical algorithm that basically takes every single zone, okay? Every single zone size, okay? And then what we do is we average them out. And then we say, okay, where you're entering. If you're entering at the volume cluster, if you notice the point of control and the volume cluster are almost identical. So if you're entering at the volume cluster, okay, and guess what? Your risk on average to every single zone is about 45 ticks on the NASDAQ on a 15. That's not that bad. So what you can say is on average, if you're running a position sizing calculator, or if you're trying to think about how big your stop loss should be, if I know that on average that every single zone produces a volume cluster entry on the zone about 45 ticks, what I'll do is I'll come in here on the prep of the zone, and I'll come in and I'll basically say, okay, let's grab a ruler from this volume cluster up. So it's pretty big. So 45 would put me just above that zone, right? 45 would put me just above that zone. The stop loss would go just above that zone. Now, I personally, before doing that my stop loss for this trade could be right about here, okay? Now, here's the thing. To me, that's a bit tight. So what I normally like to do is I would like to go and I would add an indicator called the ATR, the average range. And the reason I like the average range, I'll explain why. The ATR allows me to look at current volatility, okay? So if I can look at current volatility and I say that at this time, the ATR was about 35 ticks, okay? Then normally what I'll do is I'll try to take, you know, probably about like 1.3. So 35 times 1.3, 45 brings me right back around the same size stop. So my stop will be about that right there, which means that, you know, this trade produced pretty solid R multiple on that, you know. And normally where you would enter, you would exit. I would look to exit at demand. So I would look to try to get out near demand. Now I always try to look at the highs of the bars. So if you're coming down on structure like this, every time you get a high of these price candles, that's support. Like support's here, support's here, support's definitely there. And you know, you can see how it reacts to it, right? I would never hold to try to get right into the demand because that's getting greedy. I would always want to front run a bit. I just personally use the ATR. I prefer the ATR high-low. It gives me bigger range, Thomas. It gives me bigger environment. So if I look at the total R multiple on this trade from the entry to the furthest target, which would be here, 46 ticks of risk for a full objective of 197. That's supply zone. Not every trade's going to give you that, guys. I don't like to do that because I don't put every trade into a cookie cutter box. But that was a good trade on the NASDAQ, and it was really good, right? So if we're going to go in here and take a look at a stock, okay, take a look up here at the spiders. We're going to look at the spiders up here. You can see what happened in these demand levels. Look at this trend trade here. Look at the spiders on the trend trade. We got a big demand zone down here. We got value. Value is below this red line. So we're kind of getting around borderline in here. You're getting around the midpoint, but anything below this is starting to get cheaper, right? Well, if you look at where this zone is, technically the highest price point is here. So you're being a little bit aggressive front running this area here, but you're still with the direction. So this would be a little bit more aggressive. Price came down into this area here. You can see it came right down into the next second highest volume node in the profile. Right here down to here. Okay, that's on the spiders. Came down in there in that environment. But if you're shorting up here at the highs, that was an aggressive short. Take a look at the QQQs. QQQs looks at the futures the same way. It's pretty much the same charts, guys. These are pretty much the same charts. If we look at gold today, like holy moly. Okay, let's take a look at this gold trade. Higher high in price. So this demand zone is aggressive. Where did it stop? Point of control, volume point of control. In deep value, this is an aggressive trade. You're still a reversal trader because you're going against the market, right? The market's coming down, pullback, coming down into that demand zone. So that means you're trying to buy against the structure in value. That just means you'd be aggressive. But then what ended up happening as price lifted out of here and then pulled back to the point of control, that is a conservative trend trade. Now this zone was tested already here, but the point of control was not tested. And so that's where you can still choose to re-enter on the zone if the volume point of control is not tested, this zone is still in play. End of story. I used to think differently. I used to think that, oh, a zone got tested here, demand is done. Doesn't work like that. The demand is done if the point of control is tested. Works till it doesn't is is a jargon term. Point of control is the actual imbalance. So that demand zone, this black candle thrust, happened because of this volume at the point of control. So until that point of control is tested, this zone is still in play. Okay. So that was an example. Let's take a look at the bond market. Like a bat out of hell. They drop this. I would not be trading down here. We're outside of yesterday's range. We're outside of the map. I have no way to assess risk on this trade. I would not even touch this market until we've been to this. Okay. Let's go and take a look at some Forex markets. I got majors in here. I'm only looking at the majors for liquidity purposes. If you're looking at exotics, crosses and stuff, I don't really have time to look at them because I don't really focus on stuff with high spreads. So if you want to look at one of these, we can look at one of these. Which one? US yen. Also wants the dollar yen. Perfect. So we're coming into the open here, and so let me repeat myself. If I do not have it down here, I'm not looking at it. I don't have time to be loading a whole bunch of random markets. I have to look at the markets that the most heavily traded Forex pairs in the world are traded. These are the majors. Okay. So let's take a look at this here. Okay, this is the dollar yen. Okay. And I want to talk about what happened down here. Okay. This was aggressive. Let's go take a look at if it was even valid from a test perspective. Yeah. Where was the point of control? Point of control is there on the cluster. Next point of control is down here, but to me this zone is done. So if I'm drawing a region around this, that's the node. So if I go back to today and I look at where they tested this, right down into that environment. Now, if we were trading this, if we're in deep value, okay, if we're in deep value, structure's down, I'm an aggressive buyer down here. Okay, so if I go back, what's cool about this, it's automatic. So if you take a look, like look at the trade map, it's changing on the fly. Up. So if you think about it, I'm an aggressive buyer down here. Yes. If I go back in here to the demand zones and I put broken zones on, okay, what happens when you're aggressive? It looks great in hindsight, but you got to think about yourself in terms of risk management. Let's go see, was this zone ever tested? And that's the hard part about going against the structure, is that you want to look at past levels and see the imbalances that held versus the ones that didn't. So let's just put little lines in the sand here, because this is a demand zone. This was a demand zone. Okay. This was tested down below us. This was tested. Look at, this was already tested down here into the auction. This was tested here, so this is not valid. This was not tested. This was not tested. So if you look at what happens when they break out and the market breaks, okay, so this was tested here. So this actually held quite nicely. That was a solid trade, right? Let's continue back down. So this is done. And then we come back down to test the next one. Let's wait for it. See, this is important. This is really important. You're breaking structure. This is the difference between being aggressive or conservative. And you got to know the risks. There's risks and pros and cons to both. These two levels, these yellow levels, were fresh, untested auctions in demand, and they got run through on the news reports. But that's news reports on the GDP and stuff, guys. You got to remember, like, this morning was one of the most radical mornings of all time in a long time. And so if you take a look at where it stopped down here, almost at the max of the range. So that took it right to the edge of the range. Okay. So it doesn't matter what indicator you're doing. Okay. It doesn't matter what what market you're trading. It doesn't matter if you're a Forex or futures or a stock trader. What matters is that you understand who you are, what your time perspective is, and are you someone that's willing to let go of, you know, trying to force noisy conditions and just give yourself a little bit cleaner to look. GDP, home sales, Fed speeches, it's crazy. GDP for Forex is no joke. Market moves, man. Right? So, and if you look at the auction curve, tells you when to buy and sell, when you're aggressive. The SD volume zone tells you where to buy and sell with big volume data. And the trade map for you guys is to understand that this is to keep it simple. Like, where are you on the map? And where are you with structure? Where are the zones? And getting in at the high volume nodes. Like, that's the best. Okay. So, a couple things. We're an academy. I know I do all the presentations, but we've got thousands of traders all over the world, right? So if you want to speak to any of our students, or if you're just learning from us and you've never been to our company, or you've never been to an environment where you've been to our events, or you've been to any of our trade rooms, or maybe you've owned some of our software, maybe you haven't. We've got a very, very high we almost got a 5-star rating, right, on Trustpilot, which is a site we cannot control. So the reason we use Trustpilot is because it's meant for us to be able to have public recognition. Okay. And so I just think it's important that you understand the difference between us writing reviews on our website versus having public recognition like that in an environment that we cannot control. Okay, so I think that's important for you guys to know. If you have questions on any of our products or services, or you want to speak to our students, just shoot us an email. We'll put you in touch with some traders, and we hope you. The whole goal is to help you, right? And that type of stuff. Okay. Now, if you haven't done so already, I try to be active on our channel. I used to be a lot more active over the past couple of months, but as many of you know, we're getting ready to update our back end of the website with a whole bunch of new video training content across a lot of our products and services and our programs. So it takes a little bit of time to go through and just spend some time. But if you notice here, like, I got close to 250 videos, like 250 videos, guys. Years, been around doing this stuff a long time. I can help you. We can help you if you want it and you're willing to put in the time and the effort to do so. Hopefully today you found value in what we're talking about and you felt that it was worthy. When you get the follow-up emails, check out our reviews, check out our YouTube videos. You got to get in tune with the channel, like them, give us a thumbs up if you think it's good stuff, ask a question, leave a comment, whatever the case may be. Some gold right there on YouTube. Yeah, there's a lot of gold right there on YouTube. But I even put a recap of all the trades I took today in the auctions. Took a bit of heat on some of the markets, but definitely ended positive.